They pick out, I think there's like 8 or 10 sectors, which they're like growth sectors for the future. And you've got, technology and digital operations, life sciences, sustainability, defence, those sorts of areas. One way or another, those sectors are going to need a shed somehow to advance that.
Welcome back to Property Perspectives. I'm Ashley Toy and I'll be your host again for this series. We're looking across all the main sectors in real estate and today we are covering industrial. Throughout the series I'm joined by Tom Sharman, our Head of Research and Strategy. This episode we are joined by Steve and Seb from Newmark.
Hello.
So Steve, you are a research partner over at Newmark, and Seb, you are an agency partner. So across the two of you, I think we've got a wealth of experience across the industrial sector. So when did it suddenly become the sector that we all started talking about a lot more?
Well, if you sort of look back, right, over, since we worked together, say 10, 15 years ago, every external shock that has hit the UK economy, whether that was COVID, which had a massive positive impact, whether it was Brexit.
Positive impact on logistics.
On the Sorry, yeah. Brexit sort of helped with stockpiling, and that sort of drove demand to warehouses and pushed the nearshoring agenda and stuff. So it's been sort of incremental, it's responded positively to all these external shocks. But yeah, COVID was the main driver, wasn't it, recently?
I do remember. I remember a long time ago going to a kind of future of real estate type event, and there was a guy talking about 30 years in the future when we would have things like driverless cars and this kind of stuff, right? And I remember thinking, I came out of that talk thinking, so if we follow this through, in the future there'll be no offices because everyone will be working remotely. There'll be no retail because everyone will be doing it online. But there'll still need to be sheds to move this stuff around. Yep. So is that as true today as it was then, or what happens with kind of automation and this kind of stuff? What risks are there going forward that dynamic changes?
I mean, e-commerce is only growing still. In terms of the automation piece, we're seeing that advanced automation becoming ever increasingly important for occupiers to basically improve occupational and operational efficiencies. Not only operational, but also in terms of sustainability, those that have to adhere to sort of CSR, that's only increasing. So I think in terms of risks, at the moment, I don't really see that kind of appetite slowing down.
And for the uninitiated, you say advanced automation. Can you make that real for us?
Well, I guess it's looking at the technology that they're using, and I guess robotics is probably the easiest example. Whether you're on Amazon or you're on Ocado, we're seeing it now that they are majority of new space they're looking to take is with the idea to make it automated.
So that cuts down, one would assume, on labour involvement, physical human labour involvement within a warehouse. But how does it change the nature of the warehouse itself?
Good question. I mean, as you said, in terms of labour, we will begin to see less people in the warehouses. I think a lot of that is pick and packaging. Robots will start to displace some human elements of it. And I guess the way they look when you come into a warehouse, there will be sort of a lot more, I guess structure's not the right word, but the equipment that you would see today will be very different from the equipment that you saw sort of 5, 10, 15 yeyears ago. Yeah.
So from a kind of developer's perspective then, does that, I mean, one thing we hear about all the time is power, the requirement for power. It used to be, my kind of earliest memories as it was of logistics was how close are you to the motorway junction? And there was nothing else. There didn't seem to be any other requirement. Now power seems to be number 2, if not number 1 a lot of the time.
Yeah, and the power point is interesting. We're going through a period of time in this country where it's becoming increasingly difficult to get power. So when developers are looking to buy or acquire new sites, that is something they will look at quite closely. Where we're seeing the demand for power, one is the automation that we just discussed. I think there's a couple of other points, but I mean, EV fleets that will become increasingly important, and more common, that's a lot of power that's needed to charge those vehicles. So having that power available and also the infrastructure, often from day one of new developments, to make sure ducting's in the yard or ducting's in the car parking spaces, is becoming increasingly important.
And I guess within that, the fast charging for lorries, if you believe the trajectory of lorries, is really important. And so I guess how much does that play into the future proofing?
Yeah, and I think we're yet to see, how many HGV fleets are actually going to be electric. So that will be interesting moving forward. But yeah, it plays into that power piece even
it seems the obvious one seems to me, again from a layperson's perspective, is the kind of last mile logistics with the thousands of little vans that go relatively short distances. That seems like the obvious kind of direction. Yeah,
exactly that. And I think the important part on the power, and we're seeing it more and more now, is landlords are now starting, or landlord funds, developers are now starting to write into any sort of rent reviews, new heads of terms for occupiers, that the occupiers have to maintain a certain level of power. So if you go into a building that has 1 MVA of power throughout that lease term, whether it's 5, 10, 15 years, they will often say it will be prescribed. You cannot lose that 1 MVA of power because it's so difficult to get it back.
Okay. Yeah. Okay. So, I mean, taking a step back, I guess, from the technology side of things, just kind of moving more broadly to demand supply dynamics. Kind of, we mentioned at the beginning how industrials obviously had a great run. 10 years plus of great returns and growth. Clearly, we had a correction in kind of 2022, 23, but outperformance over a long period of time. Now, when I look again at kind of the headline data, I see trending upwards of supply, trending upwards of vacancy rates, and I know I think in one of your recent reports, that it showed a tick down after a long trend upwards of big box supply, but more broadly, you got this upward trend. How do you look at that? The market seems to be very sanguine about it, but rental growth is slowing. So is there a tipping point at some point, or why is the market so relaxed?
Well, I think we're probably over that turning point now, which was probably Q2 last year in terms of supply. And Q4 came down again, and the rate of return of second-hand space has slowed down as well. So you're still seeing occupiers trade up accommodation when a lot of leases were signed, which are sort of coming up for renewal now, or break, or like there's an event coming up. So we don't think that the supply is going to go back to the COVID lows when it was like 3.5%. I think it's going to be more gradual, given that sort of 5-year gap, and how occupiers are trading up into more efficient accommodation, better accommodation. And on balance, it's expansionary demand, which is positive, but they're sort of still releasing second-hand space back to the market. So I think like the overall supply-demand dynamics are still fairly positive, really. Maybe it's sort of more of a return to normality than like the exceptional COVID period. But even the normality of 2018, 2019 was still pretty good.
Yeah. So I mean, I remember, again, this is making me feel and look old, but in the old days it would be the older guys when I started out would say, industrial needs to be high yields because you get no rental growth, and it's kind of there's a lot of churn, there's a lot of kind of weaker tenants. A lot of those dynamics have kind of changed now, right? So you guys kind of pioneered, I guess, in a way, kind of multi-let research, which I'm very grateful for because there was hardly any of it out before. So what do you see in the market today for multi-let that makes it so different to what it was, when I started out 25 years ago?
It's a very different development dynamic with big boxes and multi-let. I mean, development margins for developers are sort of back to 2019 levels, and overall volumes are back to those sorts of levels as well for the big box. You've got very well capitalised developers who are doing that at that end. For smaller last mile multi-let industrial, you just haven't seen that development response at all. So you've got an occupier base which is expanding to deliver parcels, and there's a broad range of sectors which is sort of like very representative of UK PLC, really, multi-let industrial, because you've got all sorts of occupiers in there. So you've sort of got an expanding occupier base and a fairly static supply, and that's been really good for rents.
I saw a great line in one of your reports, a great phrase, which was the gentrification of multi-let estates, which I loved. I kind of pictured some fairly strange things with that image, but what is that about? That is, as you say, the trying to change of the tenant mix.
Yeah, it's sort of the moving away from the oily rags and the MOT centres, if you will, which is still like an important part of these, that asset class, to more retail, last mile logistics, more advanced manufacturing type operations. If you look at London, for instance, there's a lot of food specialists, and not necessarily, your dairy farm or something. This is like you're putting the final touch on a very, very petite little cake or something. So yeah, I think gentrification is it's a way of describing it, isn't it? Sort of clean, maybe cleaner operations are taking those sorts of buildings.
And do you think that trend continues in the short term? And if it does, what do you think changes it in the future?
If you look at the government's industrial growth strategy, they pick out, I think there's like 8 or 10 sectors which they're like a growth sectors for the future, and you've got technology and digital operations, life sciences, sustainability, defence, those sorts of areas. One way or another, those sectors are going to need a shed somehow to advance that those growth sectors. So it's sort of, they're very different asset classes, big box and multi-let, but they're sort of symbiotic in a way, and those sort of big overarching growth strategies are going to ultimately affect both asset classes, I think.
You mentioned defence, and it's like the property industry, as you guys know, love a big theme that kind of we can all get behind, and chimes with what we read in the papers. And defence feels like one of those that you can't kind of read the papers without hearing about increases in, or planned or hoped for increases in defence spending, and that then kind of feeds through to a hope for increase in demand for logistics industrial space. Are we actually seeing any real evidence of this, or is this still a kind of a theory?
Yeah, I mean, we've seen BAE Systems recently take space in the NatWest, which was about 500,000 square feet, and that was linked to that. We're aware that Rolls-Royce, are thinking about or have live requirements at the moment that are related to the MOD, and similarly we're aware that sort of around Reading and that area there again are military defence related occupiers looking for space. So I think have we seen it? Yes, we've seen it with BAE, and it feels like speaking to various occupier agents, including our own tenant rep team at Newmark. There's already conversations ongoing with said occupiers where it looks like they will do something within the next sort of 12 months.
And does that, when you've got defence as, I guess, the sector in the asset, does that change anything you need from the asset, surrounding the asset?
Well, it's a lot harder to track, because they're sort of necessarily confidential, these sorts of deals. But there's good data on it. There's good Ministry of Defence data on MOD spend, and information and communications tends to be sort of more London South East, and the heavy shipbuilding and things is sort of the Northwest, those sorts of areas, and that's where you've seen most demand, I think.
Yeah, it feels like from what you read, it feels like the Northwest is maybe the first that will see that sort of take-up rate increase because of defence.
I guess an element of that, I suppose, and for the industrial sector more largely, is the availability of space and land on which you can build these kind of things. You know, from a layman's perspective, you know, I think about big box, and the first thing that comes into my head is retailers. Right? Is that still the major engine of the market, or is it more broad than that?
I think that's safe to say. I mean, that's probably still that's still one of the main drivers. I think we've definitely seen a more diverse market over the last 18 months, whether that's food and beverage. We recently acted for Carlsberg, who've taken sort of 200,000 square feet at Westminster Interchange. You know, the 3PLs are all still taking space. GXO have taken a lot of the space last year at Durft. I mean, the USONs, the XPOs, all the usual suspects from the 3PL world are still active and have live requirements. The manufacturers are still out there taking space. So I think, yes, retail is still driving it, but the demand has definitely diversified across different sectors, which is really positive, because it means we're not so reliant on just the retailers to make sure that our take-up continues.
And onshoring, I think Steve, you mentioned onshoring at some point. You know, it's a kind of theme that chimes with me in the sense that it makes a lot of sense. You can follow the kind of logic through the supply chains and stuff. Is that something that are we genuinely seeing an effect there? You know, has the kind of tariffs and the greater difficulty of global trade, is that starting to increase that trend?
Yeah, I mean, the companies are looking to optimize and protect their supply chains. And that means bringing manufacturing closer to home. That's been a trend for a while now. And it's probably why we've seen like such strong manufacturing demand as well. Because if you look at like the economic data on the manufacturing sector, it's not exactly going through the roof at the moment. And, you know, like the automotive sector has its own challenges and stuff, but it's been one of the more active sectors over the last couple of years. Going back to e-commerce, which has been like had a massive influence on the sector. I read something recently that the ONS data that you can get on retail sales or internet retail sales as a proportion of all
Yeah, I'm familiar with it, yeah.
That might sort of be undercooking like the actual online habits of the UK, because formerly things which you would buy, say a newspaper or a book, or you'd go to Blockbusters and get video or something, they were described as being goods before that you would purchase. But now you have a Kindle for a book, and you get the FT on your
substituted,
phone. And so that's sort of become more of a service than a good. So that 28-29% of internet retail as a portion of all retail might be undercooking it.
Yes.
And not like on an international stage, that might make the UK like one of the most, or the UK have one of the deepest internet penetration rates.
I do often look at that, and I think you see the data for mainland Europe particularly, and it's a lot lower. And I always feel like it's inevitable that they will follow the same path. You know, maybe that's wrong, maybe they're just culturally different. But so you make your point about newspapers. I'm still old school and like my piece of paper in my hand, but I know that's a kind of rare thing these days. So that is an example where actually substitution has occurred, where that newspaper no longer needs a warehouse, right? So I guess there are corners of the technological landscape that do take away demand for industrial, but actually it's still fairly niche.
We talked a bit about Europe there, and there's been some big names that have moved about recently, specifically to focus on, I guess, industrial and logistics in Europe. Does that say anything about where we think money flows are going to go over the next 2 or 3 years? Is the UK going to continue to be as attractive as it has been recently?
Well, Newmark are sort of a global organisation, so Seb and I tend to focus on the UK sort of operationally, but we do. I personally speak to our global research colleagues, and they sort of see the UK as being like a bit of a trailblazer for last mile logistics, and we're sort of a year or so ahead, not necessarily of the US. The US is its own market, but other countries across Europe. and they sort of look to the UK to see if they can get any idea of what's happening in their own domestic markets. So yeah, it's one of the most mature and advanced and online and transparent markets out there. So it's always going to be attractive, and the fundamentals still look quite good from an investment perspective. There's still real rental growth, prime rental growth. We're still recording that, and we don't see that slowing down over the next couple of years. It's not going to be the exceptional COVID, growth that we've seen, but sort of low single-digit rental growth.
So if that is, so as you say, if and it's a theory I can kind of buy into, that mainland Europe is perhaps a few years behind in certain trends. Does that mean that if you are kind of international capital, do you then think, well, the UK is a played out market in terms of that growth kind of story, or the perhaps not growth story, that's not fair, that excessive growth, like exceptional growth story, and that moving into mainland Europe therefore would offer you that growth going forward?
I think speaking to and working with various developers in the market at the moment, I think finding funding partners for new schemes and developments over the last 18 months maybe has been slightly more challenging than it was during COVID, for example. But sentiment, certainly Q4 onwards to now, speaking to them, feels like capital is now ready to deploy, whether that's capital from Asia or America, or Europe. But it feels like that sentiment has returned, and yeah, there's multiple capital partners now ready to back developers, which is a really positive sign for us moving forward.
Yeah, absolutely. Yeah, and development viability has been a bit of a challenge across a lot of the sectors that we lend into. What I guess is required in order to improve that? What will resolve that challenge at the moment?
Well, I guess developers are influenced by positive headlines on the occupier front. If there's good news out there of take-up's gone through the roof, and so that sort of sentiment side of things, and then so that's sort of the heart, if you will, and then the head on does this make financial sense to do this? If you look at build costs, they've been relatively high and going up. And the capital value of buildings, yes, you got rents that are still growing, but yields have been sort of fairly flat for a while now. So I think there has been a development response on the bigger box side, but a lot more measured, a lot more considered, well thought through, looking at the local market dynamics than we saw throughout 2022, when the conditions were a bit looser. I think we recorded last year about 11 million square feet of development completions, which is roughly the same as 2017. So quite low in the grand scheme of things. And a slowdown of speculative development might push occupiers down the build to suit path, so they can do it themselves, rather than developers have that risk currently of a speculative building.
I think the yield shift as well is in terms of viability, that those yield shifts seem to unlock viability in a big way. So it'll be interesting to see what happens on that front over the course of the next 12 months.
Yeah. And how about in terms of in a lot of other sectors where particularly kind of offices, for example, you're seeing a real split between modern kind of well-located space, which is seeing strong rental growth and good demand, and then perhaps at the other end of the spectrum there's a lot of space that maybe is deemed to be potentially obsolete. Is there a similar picture within industrial?
We've got almost a kind of three-tier market where you have your speculative developments, you have your kind of your second-hand refurb buildings, then your more secondary kind of almost tertiary buildings. And I think where perhaps we've been quite lucky over the last 12 months is actually a lot of the 3PLs who are looking for flexible lease terms of say 5 to 3 years seem to be taking up a lot of this kind of second-hand space, because actually for them, where their margins are becoming increasingly tight, their profit margins increasingly tight for their customers that they're bidding on contracts with, if they can take a second-hand building for the term of that contract that they win, you know, at £9 opposed to £10.50, that makes sense for them. So I think from that part, take up has been quite strong, and especially if it has any fit out in it, i.e. does it have sprinklers, does it have racking, does it have fire alarm systems? You know, those three elements alone on a building of say 400,000 square feet, you could be in for £2 million worth of potential fit out savings. So that's taken up a lot of that space. I think the problem probably is for that more tertiary space where the building is probably coming to the end of its life cycle, but there's probably a bit too much value in it to knock it down and start again with a new development straight away. So that's probably the area of the market that causes a few more headaches for landlords.
So we've talked about quite a few subjects today. Is there anything we haven't talked about that you think we should be and should have up our list of concerns?
Well, if you're future gazing, artificial intelligence, the impact of AI on all sectors is going to have a massive impact. Probably on balance, it'll be like a net positive, I hope, for various reasons. But that's like a big thing that's coming down the line, isn't it? It's going to affect all.
How do you get to net positive? I've got nothing to disagree with you, by the way.
Well, just take the retail sector, for instance. If rather than using Google, you have some like agentic AI system that will predictive buy your goods for you, and it makes the whole process easier. Perhaps that will drive throughput, increase retail, perhaps. That's good for sheds in a way, on balance. I would guess you'd probably also see maybe more efficient buildings with, we talked about automation and robotics and stuff like that on steroids, I would imagine, which may mean sort of smaller, more cubic type buildings, maybe on longer leases as well, given the capex that's needed on those sorts of buildings.
I always think the kind of, they can make the inside of these warehouses so efficient in the way that they were, obviously led by kind of the likes of Amazon dealing with millions of parcels, but the bit of actually getting it from there to your home still seems to remain pretty inefficient in terms of like, I can have something ordered, delivered any day this week living in my remote countryside location, and that van has to go all over the place. So I guess you think that AI would arguably put best to use by making that process more efficient.
Increase productivity, definitely. But it's going to span so many sectors and industries that whilst individually, like you might need a smaller building for a longer period of time, like collectively it might push demand up. And the data centre market, crikey, that's probably a topic for another podcast for you.
All again,
That's if you can get the power, isn't it? If you can get a power connection to build them. I think I remember reading that if all the kind of data center planning applications or whatever went through, there wouldn't be any land left to build on, I don't think, in the rest of the country. But as you say, another.
There wouldn't be any power for the rest of the country.
Yes, that's very true.
I guess so. Just to kind of close off that AI piece, I guess it's the broad suggestion that the Internet of Things keeps taking over, and the kind of current softening we've seen reverses again, because I guess if you're pushing more through that channel, you're naturally doing less walking through the front door of a shop. So is that a part of the thought process there, or is it just that status quo everywhere else and you just get more through the last mile?
I guess there'll always be dinosaurs like Tom who wants to buy a physical newspaper.
Yes, we can only hope.
And there will be physical, goods but yeah, I mean, on balance, you can see if the process of buying something is easier, more will be bought.
Yeah.
Yes.
And that, I don't know, maybe that is a net positive.
Yeah. I mean, it's just the other day, so I have been told I know how to wear glasses. So the other day you go onto the website of a well-known glasses retailer, and the AI will kind of pick a set of glasses that look good on you and stick them on your face, on your face of the phone. So naturally then, I would not need to go into, any kind of establishment. It would come straight from a warehouse, presumably.
So on the next episode, we can see you as Elton John.
And then you may see.
Absolutely. Yeah. Thank you very much,
Great
Francis,
ideas.
Steve, Seb. That's it for another episode of Property Perspectives. I've been Ashley Toy. He's been Tom Sharman. Please click like and subscribe.